Alright. Hello guys and girls, I hope everyone had a great weekend. It is Monday today and I'm going to take you through my weekly outlook of pretty much showing you what I usually do on the weekends to assess the overall broad markets, okay? So this could be a bit of a long video, but I'm going to try my best to get through this as quick as possible really without rushing it too much and going past any major details. Don't worry if there's things that you're confused on or anything like that. All of these components will be explained throughout the mentorship and I will dive deeper into this. I just wanted to show you guys really what I do at the start of the week to set up for the week. So to start off, I go on biztalk.com, which is pretty much your one-stop shop for all news, okay? I just skim through the headlines here and read these. These are the major news points for the week, I guess. And then going down, there is news from specific outlets, okay? And you can just go through this and just read all this, skim through. There's a lot of great information on here. And I grab the most prominent information that I believe and I post them as screenshots into my journal, okay? So, for example, we've got the Trump-Greenland threat, EU retaliations on tariffs, oil prices and Iranian protests and regime change, as well as this one, which I thought was quite interesting, which is Canada turning its back on the US and partnering with China. After I do that, I go on to Polymarket. And I just have a look at what's really going on. What's the public sentiment on a lot of these things, okay? So we can see here the odds have lowered for a Russia and Ukraine ceasefire by the end of the month. I forget what this was before, but I believe it was 9% or so. Below 50%, but above 20% odds of Israel striking Iran or Lebanon, with a large 79% odds of the US striking Somalia by January 31st, okay? Then continue to go down. Here's more data about Greenland and what the odds are for that. The Iranian stuff, which has actually decreased since the protests have calmed down, as it was 19.5% last week when I did this on Polymarket. Then even looking at financials, odds still extremely high and expectations for the Fed to keep rates unchanged in the January meeting, with the odds slightly shifting from 2 to 3 cuts expected for this year, okay? And that just kind of helps me look at the markets and analyze it from a fundamental standpoint of what is expected, okay? Then I go down to the economic calendar. First of all, I look at the United States, and I'll just read this off here. So first of all, we have 3 World Economic Forum meetings this week, which could present choppiness for the markets. Expect a slow start to the week as well, with Monday being a bank holiday. The day following, likely to be low probability, as it follows the bank holiday. And as we know, the day after a bank holiday can many times be choppy and low probability. And it is the day prior to a Trump speech on Wednesday at 8:30, which is what I will really be waiting for. Then I go down and look at the rest of the world. On Monday, we've got Canada CPI. Tuesday, we've got 2 pound events, with one of them being the Bank of England governor speech. Wednesday starts off with the pound CPI in London, and then Australian employment data in Asia timeframe. Thursday has New Zealand CPI, and is filled with tentative Bank of Japan data, okay? That is tentative to change. Then the Friday is filled with euro and pound retail sales and PMI data, okay? So this is just a nice way to really put my expectations on what I expect for the markets. Of course, this isn't law, but let's give an example here. I would expect a choppy Monday as it's bank holiday, a choppy Tuesday as the day after a bank holiday, and the day prior to the Trump speech. This does not mean that there can't be rallies, can't be moves. I would just expect it to be a little bit lower probability. Then on the Wednesday after the Trump speech, I could maybe expect that to be the manipulation of the week and cause a low of the week. And then maybe these 2 days will be expansions following that. And that is how I will kind of predict roughly what I'm looking at for the weekly range, okay? And then you can do the same here with these other Forex pairs. So moving on, let's actually go into the charts now, and I always start off with the US bonds, alright? And what do we have here? As long as this old SIBI, this one in blue, holds support on price, and we do not get a weekly close below the CE, which is this line right here, this midpoint of the weekly gap, I expect price to continue traveling higher off the 2026 open, up into a premium, taking previous month liquidity and filling the unfinished imbalances. So here would be the previous liquidity, and now I will just touch on why not use this high or anything like that. Well, this is the high of September, so I am matching liquidity with time, okay? And then this here is efficient, this gap, but it is not balanced, which I will touch on in future lectures, topical lectures, okay? Because this is very important. But this would be my draw if this is to continue higher and this is not to be violated, this midpoint of this gap, okay? So just trying to get through these quite fast, but moving on. Then I look at indicators, okay, which is something I know that ICT isn't a big fan of and doesn't really teach very much, but this all comes from Larry Williams' work, okay? So now I want you to keep in mind the bond futures is what we're looking at here, as where this was the yields. So this is going to be inverted, okay? So as we expect this to go up, we are looking at this going down. Now what do we see? This line right here, this orange line, is the cycle forecast, okay? So cycle forecast calls for a retracement and then a low before reversing higher. So we've dropped off lower here. It's calling for a retracement here to make another high, which could fill this volume imbalance and this SIBI and these order blocks here, and then it wants to make another low before reversing and going higher, okay? Then I look at the COT data. Commercials have been buying through this consolidation and distribution. We can see here this consolidation and this distribution here. We're obviously going lower, right? Or on the yields going higher, remember, inverted. But what are the commercials doing? Ever since back here, we're buying, okay? We're going a bit flat here, but we can see, looking at the Wilco, which is also representing commercial buying and selling, we can see that they are above this 80 line here, which shows commercial buying, okay? Then we look at the Williams %R. It is showcasing that the market is heavily oversold, which could indicate that we are coming to at least a retracement and then possibly a reversal in the future. Then I move on to the DXY, the United States dollar. Last week's trading for DXY stopped dead in its tracks just prior to the December high, engineering lots of buy-side liquidity near this high. So last week stopped right here below this high, which again, matching time with liquidity. This is the high of December, which would be the previous, if you're looking at a monthly time frame, that would be the high of the previous month's candle, okay? Retail will look at this as a double top support to short off, but we would be counter to that, looking for the retail stops to be attacked after shaking out any weak-handed retail longs. So what do I mean by this? Let's say retail long through here, and now they see this as a double top. They're looking at this as a resistance area, and they're shorting, putting their stops here and here. And now I would assess the market. We want to come down, take out any of these retail longs that are trying to get above this high and stopping out any of their weak hands, okay, before then continuing to send it higher if we are to go higher. I would not want to see the volume imbalance be rolled over and used as resistance. Otherwise, this would indicate, at the very minimum, a deeper retracement or reversal for sell side. So if this volume imbalance here gets closed over and used as resistance, I would then expect, at the very least, us to come down into this old SIBI right here. And if we break through that, then I would expect sell side to be further targeted, okay? Now, just showing you the COT report for the United States dollar. This first one here is the non-commercials, okay? So large fund traders. This is the commercials, and this is the non-reportables, so retail. Now, I won't go through this too heavily. We see that the non-reportables, so the large funds, are actually net short with 72.5%. Then we see that commercials are actually 24% long on this market, all right? While the non-reportables, the retail traders, are just flat. So this would lead me to our bullish bias of wanting to see these highs, as we can see that commercials are in the long, okay? While retail is flat and the large fund managers are going in the opposite direction of the commercials and looking short. Even though they have increased their long positions slightly, it's still commercials who are going to run the market, all right? So then if we jump over to Euro, as we can see that Euro USD did, however, sweep its December low, which, as we see here, now remember these are inverted pairs, so what this does to the downside, this should be doing to the upside. DXY did not sweep its December high, okay, but the Euro did. So this could indicate a possible SMT divergence, that is at the very least starting a retracement to a premium. I would not want to see the mean threshold of the daily order block and CE of the orange shaded old fair value gap be closed above. This would be the first signs of a shift in daily timeframe order flow from sell program to buy program. If all is still true, this retracement should end at a premium and reverse lower to continue to the sell side objectives, such as the 2025 Q4 low. Now, what do I mean by this? Is, see, we've got this big expansion higher to this SIBI here, and we've got this propulsion block and order block right here. And this is around our equilibrium level of this range. Okay, so really all I want to see is this be a retracement to a premium, and I do not want to see the midpoint of this order block and the CE of this old fair value gap be traded above, because if we close above this and we start using it as support, then this would give us the right idea to be looking for strength really and see possible further buy side. Now jumping over to the pound. Pound gives more clarity that I believe EU and GU still have room to move lower, and that this is just a retracement rather than setting up for a reversal. Due to the fact that GU has not reached a discount of its current range, I'd like to see the premium SIBI that overlaps with the order block and propulsion block to hold resistance and reject lower. If these arrays fail to hold prices lower and the CE of the inversion fair value gap is displaced through, that would again show signs of a trend change. So we've got our SIBI here, propulsion block, order block, okay, and I would not want to see these violated, otherwise we could see potential runs to this high. Now what do I mean by it hasn't reached its discount? If we measure from this low to this high, we can see equilibrium is here, and while as euro and also the dollar have gone below into a discount, GU has not, and I would like to see that happen before any signs of an actual reversal. Okay, now jumping over to Larry and Williams' work on specifically euro futures, but I just like to use the euro a lot of the times unless pounds may be looking cleaner, but really this goes for both pairs. Okay, we can see that the cycle forecast showcasing a retracement followed by a distribution lower. So as I said, I wanted to see a retracement. We can see the cycle is calling a high in here before running lower. Now one thing I want to say with the cycles, which I will touch on, these do not call exact highs as in magnitude. Okay, so this being real low or this being a high point doesn't mean it needs to end up here. This just calls when there should be a high and when there should be a low, not the volatility and magnitude behind it. Okay, now moving down to the COT data. Commercials are net short at extremes not seen since December 2024, but showcasing short-term bullishness which aligns with a retracement. So we can see that all through here the commercials have been going very, very short. Okay, they're hedging their bets short, and this much shorting by the commercials has not been seen since December 2024. So this indicates that the commercials are very, very bearish on this. All right, but we can clearly see that we've got this short-term little rally in here inside this long lower range, which could indicate that, I believe at least, that we are seeing this short-term retracement, but the longer-term trend with the commercials is bearish. So I would expect us to trade lower. Gun to my head anyway. Now going to the COT report, we can see that the large funds are long, while also the retail traders are net long. But look at the commercials here, they are net short, getting out of their short positions by 2.6% and increasing their long positions 3.8%. Now, how does that make sense? Well, remember I said we're expecting a retracement right now, at least I am. So I believe they're increasing their long positions to get into this retracement. But again, overall, the longer term trend with the commercials is bearish. Okay, now moving on to a different sector out of the currency market, we're going to go into the indice market, specifically US indices. Now, personally, I like to look at the Russell 2000, which is the overall 2000 stocks of the US market, okay? And I use this very much the same as you might use the DXY, okay? I don't trade it, but I use it as a barometer for what to expect in the other indices. So after 2 weeks in a row of straight expansion on RTY through the previous year's high and to the 2.5 standard deviation projection level, the new week has opened up with a large gap lower, opening at exactly the low of last week's Thursday BISI. If price cannot trade above this fair value gap and use it as a reclaimed BISI, I expect it to be used as an inversion fair value gap to retrace price to a discount, filling in the large blue shaded weekly fair value gap CE. So what do I mean by all this quickly? The last 2 weeks we can see Monday here, we've just rallied. The next Monday here, rallied, okay? And then the Friday last week closed here. We rallied above this buy side, which was the 2025 high, and we reached the minus 2.5 standard deviation level. But now a new week has opened up, and look at this large drop right here, okay, right below this fair value gap, which you'd want to really see used as support if we are showing immense strength, okay? Now, we've got this new week opening gap here as well, and what I'm saying is If price retraces up into here and it cannot get above it and use it as support to continue to rally, and instead touches or doesn't even touch and rejects its midpoint, I would expect a retracement at least to the CE of this fair value gap, as we've got a discount right there. Okay, now going over to Larry Williams' work with the Russell, we can see that the cycle forecast indicating that distribution lower is inbound. Okay, we've made this high here, about to make another high here, it's indicating, and then we get this big run lower with short-term retracements. Okay, commercials have been selling their longs during this rally, not accumulating more longs, which is very interesting. So as we're rallying above here, above this buy side, what are the commercials doing? Selling short. Wilco indicator agreeing that this rally does not have commercial strength behind it. As we've rallied through this last rally here through, again, the buy side, it really just indicates to me that the commercials are selling their longs above these highs rather than accumulating more, okay? And they are getting ready to position themselves short. As this rally couldn't even reach above the 80 level to show that there is strength and volatility behind the commercials in this rally. Now, the Williams %R shows that this asset is heavily overbought, which again aligns with the fact that we could see a bit of distribution coming, okay? Now, jumping over to the COT report, we can see that the non-commercials are slightly long with a massive increase, well, 20% increase in their long positions and only a small increase in their short positions, while if we look at the commercials, they are slightly net short with 112% jumping out of their long positions, or jumping out of their positions in general. The commercials are short, but it shows that they are exiting the market, which I do believe they were selling their longs above those old highs, right? As you can see, the longs have gone down by 5.1%. Now, the retail traders are on the opposite side of the commercials in alignment with the large funds, with being slightly net long, increasing their long positions, but also increasing their short positions, okay? So moving on now to the S&P and the NASDAQ. With ES taking its previous year's buy side, but NQ failing to and rejecting off the daily volume imbalance. So what I mean by that, we can see here that ES has gone above this 2025 high, while it has not here. So this would be an SMT divergence right here, as we've not gone above this high. But then we've also got this other SMT divergence right here. Whoop. Right here, should I say, where NASDAQ, rather than going above its buy side, just reached into this daily volume imbalance that I actually called in the Discord last week. And I personally wanted to see it get above it, but it rejected it, and now we've opened with this large gap lower, okay? So same as RTY, these indices are open with this gap lower. My eyes are going to be completely glued to how we use this NWOG, which that is this right here, this new week opening gap from last Friday's close to Monday's open, as support or resistance moving forward, to paint the story of whether we're going to continue to attack the buy side or if this SMD divergence and displacement lower is going to reach for the Jan lows and discount volume imbalance. Now, this volume imbalance here is unfilled and unbalanced in the market, which does really lead me to think that they will at least at some point come down to fill this. Now, going on to Larry Williams' work with the S&P, a lot of times I will use the NASDAQ, but I personally trade the NASDAQ much more prominently than I do ES, but ES has the 500 stocks in it. It's just a bit of a bigger market, so I do just like to follow that mainly, okay, when it comes to these indicators. So cycle forecast shows that a short-term high is put in, distribution should follow. We should see here that we might get this high here, which could just be a retracement into this new week opening gap, and then followed by distribution, okay? Commercials are net short through this choppy rally to buy side, so as we've rallied up here, all this buy side, they're selling their longs again, it looks like, right? And again, same as I believe the RTY, Wilco showcasing the lack of momentum on the bullish side for the commercials during this rally higher, as we couldn't even get above this 80 zone, showing that there's not as much strength and momentum behind this rally as some people might think. Now, slightly oversold, indicating that a possible retracement might be inbound prior to the following distribution lower. Now, we're not at exact extremes yet, but I do think that we could maybe see a retracement into this new week opening gap and then further distribution, alright? So then jumping on to the COT report, we can analyze the S&P and the NASDAQ here. We can see that the non-reportables are slightly short with a decent increase in their shorts and a slight increase in their longs. We can see that the commercials are exiting their longs and exiting their shorts and pretty much flat here, okay, on a neutral stance. Then the retail traders are net long, increasing their longs a little bit and increasing their shorts, okay. Now, if we look at the NASDAQ, we can see that they're actually, the non-reportables, the non-commercials are very heavy net long here, while the commercials are net short, but also getting large percentages out of both long and short positions, while we see that the non-reportables, the retail traders, are also short here as well, exiting both of their long and short positions as well, okay? Now, moving on to gold and silver. It's easy to identify through order flow that gold and silver markets are extremely strong right now. Retracements are spending barely any time at all at discount arrays and not even reaching the midpoints, then displacing away higher with a lot of strength. Gold looking to reach its 750 big figure, and silver at the 100 big figure. Now, what do I mean by you can see clearly from order flow that they're extremely strong? Well, if we look at least even just these past few short retracements here into rallies, we can see that these lows didn't even come down to the midpoint of this gap, okay, before rallying higher. And then last week, the Friday didn't even come down again to the midpoint of this gap before rallying higher. And we also see that this week opened up with a large gap higher after last week's Thursday and Friday had this little SMT at the discount array, all right? So I'll touch more on that in the future, but this is a clear sign that this is a strong market, all right? Now, going on to the gold COT report, we can see that the non-commercials, the large fund traders, are very, very heavy on the long side right now, okay? While the commercials are very heavy on the short side, okay? Increasing their shorts by 8%. And then the retail-minded traders are net long, okay? So this does lead me to believe that maybe this rally might be stopped soon, all right? As the large hedge fund managers and whatnot institutions are trend following long, and the retail-minded traders are also trend following long, but the commercials are setting up for heavy, heavy shorts here, okay? So just be wary of that in the future. Now, moving on to US oil. After taking the December high but falling short of the previous quarter's high, which is taking this high here and falling short of these highs here, I am watching this discount inversion fair value gap and order block to see if they hold support and rally price higher. Retail are short off the double top formation, but I am looking at it as engineering of buy-side liquidity. If the inversion fair value gap and order block do not hold and their respective levels are traded through, that would lead me to abandon the idea of current long. So what do I mean by this is we've gone above the December high, taken this buy side, left, these are already equal highs. We've left another high in close proximity to these, and now as we're trading lower, retail are shorting this with their stops above here and above here. But I am looking at this as a potential retracement, and this just being engineering liquidity for us to go down to a discount and then come up here later to fill this inefficient SIBI. Now, what would stop this idea, as I've said here, is if we see price start coming down here and trading below the midpoint of this inversion fair value gap, trading below this order block and using it as resistance on price and continuing to displace lower, okay? That would invalidate the idea of longs for me. Now, moving on to still oil, but with Larry Williams' work. And on this one, I have actually used the weekly time frame and included the seasonals just because I thought it was the cleanest and presented the best information and data for crude oil, okay? So seasonals in blue and the cycles in orange showcase a low has been put in and bullishness is inbound. So we can see here, it showcases a low right here and that expansion higher is coming. Now the cycles also indicating a low has been put in and going to be followed by, which I've cut off here, but I believe I said rally or bullishness, all right? So if we match these up, yeah, we can see that they both indicate a low has been put in and should be followed by expansions, all right? The commercials are net long at levels not seen in years. So if we scrolled back here, and this wasn't a screenshot, the commercials are more heavy long than they have been in many, many years, all right? So that really does indicate to me that we are setting up for some strong bullishness. Of course, with the whole Venezuela stuff, with the US as well, that is obviously tying into it, all right? Now, Williams percent are showcasing that we aren't even overbought yet. Okay, as we haven't gone above this line, as we see every time we get above here, starts dropping. Well, we're not even overbought yet, and it's got a lot more room to rally, I would assume then, okay? So, moving on to the crude oil COT report, we can see that the hedge fund managers are slightly, and institutions are slightly net long, with the commercials surprisingly being quite flat here, alright? While the retail traders are also quite flat, increasing their short positions though, and getting out of their long positions, which makes sense as to what I said with them having their stops above here and seeing this as a resistance area to short off. While the commercials are slightly increasing their longs more than they are increasing their shorts, and the non-commercials increasing their short positions more than increasing their long positions, alright? So that all lines up. Now, moving on to the last asset class that I'm going to mention here is Bitcoin and Ethereum, okay? So, been calling since the beginning of the year that I wanted to see Bitcoin rally up into its premium array and take the buy side, which is this premium array here and this buy side here, before dropping off lower to continue to its higher time frame sell side objectives, which would be all these down here. For this to continue true, I would need to see this discount array be inverted and used as premium sensitivity to displace price lower. Now, this here is a weekly gap, and this here is obviously this daily BISI. Now, I would demand to see, unless we're going to put in another high before continuing lower, I would demand to see something like this, where we trade up into here and reject it and trade off lower below the 2026 low and then measure strength to see how far down we can get, okay? And obviously the same said with Ethereum, and I am looking at this red line, which I have measured out the SMT divergence, okay, which adds to the idea of expecting shorts in the market. Now, I did use Larry Williams' work here on TradingView, as it doesn't really work as well for me on NinjaTrader right now. I got to set up a few things, but after rejecting off the midpoint, because this is the COT data here, after rejecting off the midpoint of the 6-month range, the commercials are hedging shorts below the net zero line. So we can see that the commercials were rallying through here, and as we've gone through this midpoint, where if we'd gone above this, I would assume that they're hedging their bets long, but we rejected it, and we've got this decently heavy drop here, which is gone below the net zero line on the COT report, okay? So that indicates to me that the commercials are looking for shorts, with Wilco indicator falling quickly from bullish to bearish from up here. We've now gone below this line here, indicating to me that this is true, where we're seeing commercials hedging their shorts, alright? Now, I don't know why I didn't continue writing this stuff here. I must have forgotten about that, but we can see that using the Williams percent R, we were in an overbought situation up here, and now we have started dropping, and we are not yet in an oversold condition, okay? Which means, to me, would lead me to believe that there is more room to run lower here, okay? Now, lastly, looking at the Bitcoin COT report, we can see that the non-commercials are pretty much flat, but have increased their long positions by 6.2%, as where their short positions only were increased by 1.7%. Now, if we look at the commercials, we can see that they are only slightly more net short, and they don't hold a large position in this market in comparison to the non-commercials. But look at that, right? So first of all, they have decreased their longs by 6%, but increased their shorts by 104.9%, okay? So this really also leads me to believe that we're setting up for shorts on Bitcoin. Now, the non-reportables, they are just pretty much flat as well, increasing their shorts by a little bit. Alright, so that is really all I have for you today, guys. I'm sorry for going through it so quickly. I will touch on more in the future, but otherwise this would have been an extremely long video. I just wanted to showcase with you guys quickly a quick idea of what I do every week when I sit down at the markets to look at the broad spectrum of the markets. And keep in mind, we can use all of these together. I'm not just looking at them individually. I am really making an assessment on the whole market sentiment, okay? That is really all, guys. I enjoyed speaking to you guys. I hope you found value in this, and I'm looking forward to speaking to you in the future. Take care. Peace.